and this is going to be moderated by the Chief Editor IPs of the Times Network, our very own Mihir Bhatt.
Thank you, everyone. After this enlightening session of Gaur Gopal Das ji, we will try and keep this very simple and not try and overanalyze the economic situation and try and come up with some simple action points, because our theme is aspiration to action. But welcome all of you. Thank you for joining us. Nilesh, I'll start with you. You know, I mean, everybody has been talking about the slowdown in economy, and I mean, we have seen a couple of downgrades also when it comes to the growth prospects. But we are talking about the aspiration that India has set for itself, $5 trillion GDP by 2024. You know, to achieve something like that, and especially the situation in which we are right now, we really need to do something extraordinary. What are those steps?
So essentially, three things. One, encourage entrepreneurship. Support entrepreneurship. Second, provide those entrepreneurs with capital, debt, equity, maize, whatever it is. And in this context, I just want to highlight one obsession of Indians. In last 8 years, we have remitted $245 billion for import of gold and precious stone on a net basis. We do know that gold smuggling exists. Estimate of this year's gold smuggling is 140 tons or $7 billion rounded off. That's roughly $300 billion remitted abroad. If that savings was remaining in India, our GDP would have been higher by 11% this year. So keep savings in India, augment it with foreign capital if need be, but provide that capital to entrepreneurs at a reasonable rate so that they can go and create industry. And third, support those entrepreneurs with rule of law. A simple example, there is a law which says that if your check bounces, you'll go to jail. There are now 40 lakh cases pending in the court of law, but those people are not in the jail for sure. If you can't enforce contract, how will entrepreneurs build business? So just three things: encourage entrepreneurship, provide them enough capital at reasonable cost, and create a rule of law. It's not that we are missing all of this. That's why we are at $2.7 trillion last year. But if we improve upon it, then $5 trillion is easily achievable.
Right. Prabhat, my next question is for you. You know, the three steps that Nilesh mentioned, actually if we analyze what the present government has done since 2014, they have tried to do this maybe in bits and pieces, maybe through some schemes. So we have Startup India movement, we have Make in India, and various other initiatives. Have you really seen the kind of impact that was expected at ground level, at grassroots level of these initiatives?
So I think, well, obviously we have slowed down, first of all. So I think there has been maybe too much of reset, first of all, because, you know, if you try to correct too many things at one point in time, it first leads to a slowdown. So if you sort of, for example, do RERA, you do DMON, you do GST, and try to do too many things, system is functioning in a certain fashion, it leads to a breakdown at some level in terms of cash flows, etc. That is, I think, the first problem. The second issue is, I think, what Nilesh said, the fact is that the growth actually comes from risk taking. And if risk takers are not getting, well, adequate compensation for risk they take, then they will not take risks. And essentially this means is, if you really go back and see last, let's say 5-7 years, right? All the big risk takers who took risks either in infrastructure or in telecom, I mean, take whatever sector, essentially their returns have been either negative or they've sort of seen their balance sheet erode or sort of gone out of business. And I think while the cost of a capital itself has come down, but the opportunity as investors see them have not yet come to fore. All the steps that you're talking about essentially are more about hygiene factors, not about something that leads you to take risk. And so I think the issue in India today is that the confidence about getting return on your capital is missing. When you do a government project, will your money come back? If you do a project, infrastructure project, it gets stuck in a state, will your money come back? Stuff like that. So I think rule of law. So putting capital is easy, but getting return out of that is, I think, what is broken. I think that confidence has to come back, essentially.
Right. In fact, that leads me to my next question. Neelkanth, that's for you. In fact, in last 2-3 years, what we have seen is even corporates who have raised money, a lot of it has been actually used to maybe service debt rather than investing in new capacity, creating new capacity and effectively generating jobs. What's your take on that? Because that's I think one of the cause of concern when it comes to the current slowdown we are in.
See, the current slowdown, now it is, I think, progressed so much that we'll need stronger intervention. But I think the origin of this is our inability to follow through on our success in controlling inflation with lower interest rates. See, this is one of the biggest adjustments that has happened in India. So over 60 years, our average inflation has been 7.5%. The last 4 years, it's been about 3.7. And the cost of borrowing has not come down. This starts with the government. So the government's debt to GDP is 45%. The cost of debt is 7%. The interest cost per year is 3.15% of GDP. I mean, how can fiscal deficit come down below 3? The problem is that because inflation has come down, it is no longer possible to do 14-15% nominal GDP growth. Last quarter's growth was 6%. So it doesn't give you the tax dollars to even, as Prabhat was saying, that if risk capital has gone out, India is anyway a poor economy on a per capita basis. There's not too many people who have 500,000 crores of risk capital to put into large projects. Where the government could have put it, the government is also starting to get constrained. So I think on the private side, there was a necessary correction, especially in power generation and metals, which I think was behind us. Last year, at this time, it seemed like the sector would have taken off. But then, we were unable to address the financial system problems early enough. And now, with 1 year of growth slowdown, into 1 year of growth slowdown, I think just solving the financial system problem may not be sufficient, but I think has to be our first step. So we need to bring down interest rates, effective interest rates, rapidly. Because of the no-cut response last week, the interest rates for nearly a third of India's financial system have actually gone up by 20-25 basis points. In a slowing economy, I think that's terrible. So we need to get interest rates down. We need to expand financial system capacity because the PSU banks, which had for a long time, who were very used to giving large tickets and large checks, the current system requires, say, instead of 1,000 crore check, you need 1,001 crore checks. Are they geared for that? Do they have the processes, the system, the people for that? And if they do not, then where will credit come from? So for 2-3 years, NBFCs did that, but right now there is a problem of financial system capacity as well. I think all of these things over time will get addressed. I mean, we've seen that over 30 years we've delivered 7%. But these, I would say, would be the primary challenges right now.
Right. In fact, let me bring in Dr. D. Subbarao. And two key points that I would take away from your answer. One is the deficit. Now, when we look at the fiscal deficit number and if we add the state's deficit to that, I think that number itself sounds like a very dangerous number. So, Mr. Subbarao, thanks for joining us. What is your take on this combined fiscal deficit of states and center, and then obviously some of the unaccounted expenditure which is currently not reflected as a part of that fiscal deficit number? How serious is that challenge for us at this point?
Most certainly, both the quantum of fiscal deficit and the quality of fiscal deficit are a cause for concern. The first point is that The true fiscal deficit of the central government and of most state governments is higher than what is admitted. There's been a lot of budget borrowing, of balance sheet borrowing, and there have been deferred payments which will all add to the fiscal deficit. What is even more worrying is that it will be difficult for the central government and the states to meet this year's fiscal deficit target, if only because the nominal growth has come so low, 6.1% by the latest reading. We know that revenues are correlated with the nominal growth, and if nominal growth is so low, it's unlikely that revenues which are already slowing will pick up. That's about the quantum of fiscal deficit. What about quality? It'll be okay if the governments borrow, central government and state government, in order to invest in production capacity, in order to invest in infrastructure. But if all the borrowing is used for what we call revenue expenditure, current expenditure, then I believe it is going to be even more damaging. We know from our own experience that fiscal deficits are bad. They fuel inflation, they crowd out private investment, they impair the balance of payments, they add to current account deficit problems, and all these problems we have experienced. In fact, every balance of payments crisis we've had, the 1991 crisis, the 2013 rupee tantrums crisis, can be traced back to fiscal profligacy. So I think we've got to be very careful about managing our fiscal deficit and keeping within the fiscal deficit targets.
Right. Nilesh, I have a follow-up on this. Now, clearly government, if the situation doesn't improve on the deficit front, government is going to be in a tight corner in increasing their expenditure. So, how do we get out of this?
So our government might be income poor, but certainly is asset rich. Since 1965, we have created custodian of enemy property. There are about 9,000 odd properties valued at more than 1 lakh crore lying over there. Is it a good time to utilize those money? If we go to United Kingdom, Margaret Thatcher, when she became Prime Minister of UK in a tough time, she started selling everything which had a British name on it. British Railway, British Telecom, British Airways, British Cash. She didn't even stop at that. She started selling public gardens. She started selling bungalows in which, the government officers were staying. She ensured that the unutilized, unproductive assets of government were liquidated to generate necessary cash. The third thing is example of Hindustan Zinc. In 2001, it was a loss-making company making 250 crore loss. It had incredible assets in a mine called Rampur Agucha. Today, when it is in private hand, it makes 10,000 crore contribution back to the government, and from 100,000 tons zinc production in 2001 is making 15 lakh tons of production. It's 15 times growth in about 18 years, and from 250 crore loss in 2001 terms to 10,000 crore profit. Now imagine there are so many options available to government to liquidate their assets, to improve their unutilized assets. So we are income poor today, but we are definitely not asset poor.
That's a very good point. But while we speak about the domestic issues, I have Mr. Deepak Bagla with us, and he obviously oversees the whole investment corridor between India and other nations through Invest India. Deepak, thanks for joining us. While domestically we have seen the credit crunch and the slump in demand, and like Nilesh mentioned, that too much of regulation may be causing a bit of a slowdown, we keep reading about India receiving record number of FDI proposals. How is that landscape currently?
I think this is very interesting. I think we are at this very interesting inflection point, both socially, economically, and politically. And typically what happens when you're at inflection points, you might overstress the immediate and at times lose the stress of the past and the future. Let me just share how the foreign investor today is viewing India. And let me put it a little in perspective. From 2000 to 2019, the total FDI India received was about $630 billion. Right, Nilesh? You're a man of numbers, so you'll be a been out. 50% of that has come only in the past 60 months. 50%. We've had over $307 billion come only in the past 60 months. What's more interesting? 92% of this over 300 billion came in the automatic route. Sir, you're sitting in front of me, you know that. That means it did not require any specific foreign approvals. That means that we are now one of the most open economies on the planet. And you know what's furthermore interesting? 40% of this 300 odd billion is greenfield investment. For the first time, we've had greenfield investment, which actually year before last overtook China in a number. The foreign investor is today willing to take a long-term call on you. And why are they willing to do that? Do I have 2 more minutes to explain that?
Yeah.
The reason is, one is the huge opportunity which sits, we all know it, 100 smart cities, every minute 30 people moving from a village to a city, 300 million people in urbanization. Actually, and again you will know it, last year we moved 8 billion people officially on our railways. We actually moved the entire planet. The more interesting thing happening there is that the foreign investor today believes it's not just the opportunity, it is his ability to access that opportunity which is now becoming easier in India. And I'll give you a number on that one. You've heard about the ease of doing business. We moved from the 140s to the 60s, 70s. You know how complex we are, or we were as a nation to work? To make that movement from 140s to 60s, the central government and the state government together did over 13,500 policy interventions. 13,500 policy interventions in a period of 60 months, and that's when you only move that little band. See the complexity, but then what has it resulted in? And these are my last 2 points. I could continue actually on this one. The last 2 points on that one. One is, never before in human economic history, think about it, a brand new company got 100 million new customers in 180 days. Or a brand new company coming from a neighboring country got 30 million new customers in 36 months. In fact, when I just mentioned the statistic last week, he corrected me, he said it was the other way around. And let me give you another interesting one, and that's where I take to my inflection point. When you're at inflection point, you can take the stories of the past, or you can take the stories of the future. And what I'm sharing with you are some of the stories of the new India. A company, from the day their global board gave them the approval to set up a manufacturing unit in India, and set up a company to create the world's largest wind power blade. You know those wind things?
Yeah.
They're in over 12 countries. And when we met them in our team, they said the best experience they'd had was in China. It was done in 18 months and a few days. And they had walked into our office, and our team told them, so we'll break this record. And I walked out and I said, there's going to be a tough one. They had one of the big fours which was consulting them, and told them in India, it'll take you anywhere between 5 to 6 years. From the day their board and their head office gave them approval, to the day the first blade came out of their factory in India, was done in 14 months, 23 days.
All right, so, obviously there are positive stories, but Neelkanth, broadly, do you share this kind of optimism? Because the FDI number may not necessarily reflect the real situation on ground.
See, a lot of the trailing 12-month FDI, so net FDI is at a record high of 38 billion. Yeah. It had been stuck in the 30-35 billion for a while. Gross inbound FDI is 68, which was also stuck at 65 or so. Some of that is inflated by what's happening in telecom, the rights issues that happened, also real estate purchases by big foreign firms, or yield chasers. But I think there is something much more strategic starting to happen, which is that because of Chinese demographics, there is, just in the last 4 years, almost 2 crores, so 20 million workers have moved out of manufacturing. And with or without the trade war, the truce or whatever is happening, there is a structural shift. So we had done a report on this. We also surveyed companies where the revenues add up to $1 trillion annually. And almost everyone wanted to shift manufacturing out of China, right? For global reasons. I mean, there's enough business for them in China, so they want to keep manufacturing there, but incrementally their investment is outside. There is a significant opportunity and there is no one else. So if you think about 5 crore people going out of the workforce in the next decade, there are very few countries in the world which have that kind of ability to absorb. I mean, Vietnam is going to fill over in a few years. And I think, hubs like Greater Noida, Chennai, I think these are hubs that are starting to attract very good quality FDI as well. That maybe is still a small number of that 38 net and 68 gross, but I think in the next 5 years, if we get our act right, we have a very big opportunity.
Okay, let's hope for that. Mr. Bhatia, this question is for you. The other part of the major concern is actually the slowdown in the consumption. And some of the sectors we have seen are failing to kick off, be it auto to some extent, but real estate. And we have seen fall in demand even in rural consumption now. So, I mean, is worst behind us? Are we somewhere in the middle of the curve? What's your take?
So I think the topic this afternoon was, whether we hit 5 trillion or not. So it's a matter of time. There's a certain amount of inevitability to it. We hit $500 billion around 2002, and then look at the pace, So when you talk about 5 trillion, you are coming close to Japan actually, if you talk on GDP terms. But on PPP, we are already kind of ahead of them. I remember the first time I visited a G7 country, it was in 1997, and it was in Japan, and we landed at Narita and said, wow, what an airport. And today, in India, you have Delhi, you have Bombay, you have Hyderabad, you have Bangalore, and so many other airports coming up. So, in India, I think, and I echo what you said, structurally things are changing very, very fast. So whether you talk about the IBC, you talk about taxation, Japan had their big bang, in 2001, 2002. We are merging our banks now. They're going to be only 12. They're going to be stronger banks. Things are going to happen very, very fast from here. Money is waiting. A few weeks back, our joint venture partners were here and said, in France, nobody wants deposits because nobody can give them returns. Nobody wants insurance premium because where do they get their returns from?
Right.
This is going to happen in India. Now, you talk about, whether the auto thing is going to come back or real estate is going to come back. Of course, where is the growth? It's in India. And look at the cyclical bit of it, right? You're moving from BS4 to BS6. So people will perhaps wait. You are getting into a sharing economy. So if growth doesn't happen in auto, it's going to happen somewhere else. But it is going to happen out here and nowhere else. And look at the location of India. The next round of growth is going to come in the Middle East. It's going to come in Africa. And Vietnam doesn't have land. This is where it is.
Yeah, that's true. I mean, obviously there are positives. But Prabhat, do you think we ended up doing too many structural reforms or maybe too many structural changes? When we talk about GST, we talk about RERA, IBC, and a lot of other things, including demo, obviously. You can't forget that. You think we rushed into it?
So I think, first of all, hindsight is 2020. So I think you can sort of say it all happened together because we are sitting here at a point in time when the growth is really low. And we can always say that and obviously there's a lot of talk about slowdown in real estate, slowdown in infrastructure, slowdown in... So obviously there is some of that has happened because, in hindsight, things happen too fast. The problem today, I guess, is that nobody's able to put their finger on when this inflection takes place. We've been waiting for this inflection to happen for a while.
Right.
And I think the problem actually, I think we had to start to recover. If you really go back and see before the NBFC crisis, growth was actually, had picked up a bit. Things were fine, autos were doing well. There was some pickup in capex. And then we hit this financial crisis, so to say. And do remember that NBFCs were about 40% or 40 to 50% of net credit, probably a much larger number in terms of gross credit because their books churn faster. And a large part of that credit just went to zero because a certain number of companies just not able to disburse. Their balance sheets have shrunk. And as a result, I think we got a shock, a financial shock, which was, very, very steep. I think we got a shock in Lehman crisis, we got another shock, which was completely, built in India, but it has impacted the economy in a manner that I think has not happened in a very long time. The flip side of that is that we have essentially seen a huge slowdown in consumption, but it's also led to a lot of liquidity creation in the system. It has led to a BOP surplus. So what has happened is that we've gone back to something like 2002, where if you remember in 2002, we had a we had a fiscal deficit problem, but we had lower interest rates, we had a BOP surplus.
Right.
Our economy was actually very slow. But the thing that happened in 2002 was that a number of structural reforms took place in 2001, which opened up the economy. Power sector was opened up. A lot of sectors which actually took off were opened up around 2099, 2001, 2002. So this advantage of this lower interest rates and pushing that capital into these sectors because there's an opportunity happened around that time. And if you really look at both the growth episodes in India, 94 to 97 and 2001 to 2007 or 11, 12, wherever you want to stretch, it happened because, the fall, the correction in macroeconomy was followed by opening up of the economy in some places. And I think there is where our struggle is. Which are the sectors which will take up the load, essentially? In 2002, it was power, it was, But the problem today, I think the struggle is that the traditional sectors which have driven capex are not really firing all cylinders. So I think we'll get a pickup, but it might be shallower and simply because, or it'll be much slower pickup simply because of the fact that we really don't have too many sectors which can drive growth very fast. We don't have too many risk takers in the economy despite the lower cost of capital. But we will get a pickup. I think we'll rise from here, but it might be a slow process. Yes.
Right. We are short of time, but I'll quickly do one poll. So all of you, please hold your mics, and then I'll toss this question to you. Nilesh, do you think 5 trillion by 2024 is a realistic number, or we need to move? I know we'll get there.
So if it is Mr. Modi's target, then it will be difficult to achieve. If it becomes your target, my target, and everyone's target, it will be easier to achieve.
Brilliant. We actually championed this cause last year as well. Mr. Bhatia, your take.
I think 2025 will be more realistic.
25.
25.
Okay, a lot of people would believe that's optimistic right now. Prabhat?
Yeah, I think 25, 26.
25, 26. Wow. Neelkanth, your take?
No, I think with some changes in the next 2 years, it is achievable.
By 2024, it's achievable? Or 25?
See, 25, it's about a 5-year target, so count 5 years from here.
Yeah. Mr. Bagla.
12 महीने से फर्क नहीं पड़ता. But just look at it. All 4 of them said we are getting there. And now you get there on October 2024 or you get them on March 2025, उसमें फर्क कितना नहीं पड़ेगा.
Right.
The point is, you're getting there, and I completely agree with Nilesh. A government can only create an ecosystem. It can only be managed, performed, and executed by all of us as people together.
Right.
No
I think
alternative.
that's the key takeaway. Thank you so much, gentlemen. Thank you, Mr. Subbarao. It has to be our target, 5 trillion. Thank you so much.
Well, thank you all.